Welcome, you curious listener, to the Deep Dive. We're so glad you're joining us today because we're not just dipping our toes. We're plunging headfirst into this incredibly intricate and often surprisingly personal world, how we make financial choices. This isn't just about numbers on a spreadsheet. It's really a journey into the very heart of what drives us when it comes to money. And that's a topic that truly touches everyone.
Today, we're diving deep into the science of financial decision-making under stress behavioral finance. Our mission for this deep dive is to pull back the curtain on those hidden forces. The psychological principles, the emotional triggers, those subtle nudges that shape how we manage our hard-earned cash, especially when the pressure mounts. We've got a fantastic stack of sources for you today, ranging from some really deep academic research on investor behavior in places like Norway and Indonesia, all the way to practical, actionable advice from financial wellness experts.
By the end of this, we want to arm you with the knowledge and strategies to navigate your financial world with, hopefully, a newfound clarity, motivation, and a real tangible sense of control. Okay, let's unpack this.
Indeed. And we're moving beyond just the numbers and the market charts to understand not just what happens in financial markets, but crucially, why it happens within us. Our brains, magnificent as they are primarily designed for survival, which, maybe counterintuitively, can sometimes lead us significantly astray in the complex, often abstract landscape of finance. With over a decade immersed in financial psychology, I've seen firsthand how these internal mechanisms, those cognitive shortcuts and emotional responses, can really trip us up. So this deep dive will help you pinpoint those tendencies and then offer tangible ways to make more informed decisions, even when things feel turbulent or uncertain. Think of it as gaining a deeper understanding of your own financial self, which in turn empowers you to proactively manage and, dare I say, even outsmart some of your own inherent wiring.
Okay, so to kick us off, what exactly is behavioral finance? It sounds a bit like an academic mouthful, like something you'd hear at a university lecture. But from what I understand, it's actually incredibly practical and immediately applicable to our daily lives.
You're absolutely right. It sounds more daunting than it is. At its core, behavioral finance is simply the study of how psychology influences the behavior of investors and financial analysts. You see, traditional economics often operates on this assumption that we are perfectly rational, logical beings when it comes to money.
Right, the economic man idea.
Exactly, that we analyze all available information, weigh the pros and cons, and then make these optimal decisions. But behavioral finance comes along and says, hold on a minute. It recognizes that we are, human. We have limits to our self-control, we're influenced by deeply ingrained biases, and our emotions play a much larger role than traditional models would suggest. It tries to explain why market participants often make systematic, irrational errors that consistently deviate from those purely rational assumptions. And these errors, over time, can significantly affect prices and returns, creating what we call market inefficiencies. To give you some context, this field really gained traction with real-world financial events that, they just defied traditional rational explanations. Think back to the Japanese market bubble in the 1980s. Stock prices soared to utterly unrealistic valuations. Price-earnings ratios reached triple digits.
Wow.
And at one point, Nippon Telephone and Telegraph had a market valuation that exceeded the entire market cap of West Germany.
That's staggering.
It really was. The Nikkei index nearly doubled in just 2 years, hitting 40,000, only to then crash to half its peak in less than a year. Then fast forward a decade to the dot-com bubble in the U.S. around 2000.
I remember that.
Yeah, new internet technology companies, many with no profits or even revenue, reached market valuations in the billions. This bubble, too, burst, reducing many of these stocks to just a few % of their former value. These dramatic swings, happening without significant changes in underlying value, really challenge that idea of perfectly efficient markets.
So these weren't just random market hiccups, but clear patterns of irrational behavior that the old models just couldn't explain.
That's fascinating, and I imagine some of these insights go even further back, right? It wasn't just these big bubbles. They absolutely do. We can even trace some of these insights back to the groundbreaking work of experimental economics pioneers like Vernon L. Smith. He actually won a Nobel Prize for demonstrating these phenomena in controlled lab environments. Smith and his colleagues conducted experiments where participants traded a simple asset. This asset paid a fixed dividend for 15 periods and then became worthless, so its rational value was easily calculable.
Okay. Pretty straightforward.
Think. But contrary to classical economic expectations, trading prices often soared far above their expected payouts, creating these experimental bubbles that later crashed. What's more, their experiments showed that if you doubled the cash supply while keeping the number of shares constant, you essentially doubled the magnitude of the bubble.
So more money just inflated the irrationality.
Precisely. It provided quantifiable evidence that human behavior, driven by things like social biases and systematic decision-making errors, was driving these market anomalies, not pure rationality. These findings aren't just academic curiosities. They illustrate how human behavior can push markets far from any fair price equilibrium. It's clear our brains aren't the purely rational calculators traditional economics assumed.
That's incredible that even in a controlled experiment, our human tendencies can create financial bubbles. But what happens when that human element, those psychological factors we've been discussing, intensify under stress? When you get that pit-in-your-stomach feeling during a market dip or that racing heart when you check your bank balance after an unexpected expense, is that just a feeling? Or does it trigger something much deeper physiologically that pushes us further into these financial pitfalls?
That's a powerful question, and it's definitely deeper than just a feeling. When we experience stress, our brain literally shifts into a survival mode. It's a fundamental biological response honed over millennia to protect us from physical threats. The problem is, this mode is absolutely not optimized for complex financial calculations or long-term investment strategies. Normally, the prefrontal cortex, that highly evolved thinking part of our brain responsible for rational decisions, planning, accessing memory, that guides us. It's our CEO, our strategic planner.
Right.
But under stress, that executive function takes a back seat. Instead, the emotional center, primarily the amygdala, our brain's primal alarm bell, responsible for processing fear and emotional memories, sends urgent, often alarmist, signals to the hypothalamus and brainstem.
The older parts of the brain.
Exactly. Older, more primitive parts that control automatic functions like breathing and heart rate. This immediate cascade triggers a fight-or-flight response, which effectively hijacks our prefrontal cortex. It overrides our ability to think clearly. Dr. J.D. Baines, a senior scientist, explains that our brain activates different circuits designed for protection, leading to a reallocation of our metabolic resources away from rational thought. In this state, our perception of the situation also skews negative. Our brains are designed to protect us from danger, so when the outcome is unknown, we're often biased towards anticipating a negative outcome because, well, that could be life-threatening.
That makes sense from a survival perspective.
Totally. But it means we can't truly make a rational decision because so much of our energy and thought processes are diverted to anticipating and reacting to danger. Imagine trying to make complex investment choices, like deciding whether to sell a stock with strong fundamentals that has temporarily dipped, when your body genuinely thinks you're being chased by a bear.
Wow, so our brains are literally hardwired to react emotionally to perceived threats. And a volatile market can certainly feel like a threat. It's like our higher level thinking gets temporarily unplugged. And this isn't just about big, scary market crashes, right? Even daily mundane stressors can take their toll and impair our judgment.
Absolutely. It's not just the big, dramatic market swings. Everyday cognitive demands and internal states can profoundly impact our decision-making capacity. Consider this fascinating study on parole judges in the United States. You'd expect their rulings to be based solely on objective factors like the case's facts, the crime severity, prior precedents.
I hope so, yeah.
But the study found that the single most highly correlated factor with their decision-making was actually the time of day. At the start of the day and immediately after breaks, parolees received favorable rulings about 65% of the time.
Okay.
However, the percentage of prisoners granted parole dropped drastically, down to nearly zero in the hour or so before lunch and before the afternoon break.
Seriously. Just because they were hungry or tired?
It points strongly to what's known as decision fatigue. Our cognitive abilities fluctuate, and simple tiredness or hunger can significantly affect our judgment. Now imagine combining that kind of daily decision fatigue, say, after a long day of work, or trying to manage kids and household chores with financial pressure. Suddenly, deciding on a mortgage refinancing, reviewing investment statements, or even just budgeting for groceries becomes a minefield. Our judgment is significantly impaired, making us susceptible to those easy but often poor choices.
That really puts it into perspective.
It does, and it raises an important question. What are the specific psychological factors and emotional habits that influence our financial decisions, particularly when we're already under stress?
Okay, now let's dig into the specific ways our minds can trip us up.
and the surprising habits we might be falling into without even realizing it. Because it's not just the big, dramatic emotions, right? It's also these subtle cognitive traps that can quietly erode our financial well-being.
Exactly. We've got several key psychological factors and cognitive biases that play a significant role, and they often work together, kind of creating a complex web of influence. First, let's talk about the weight of financial stress and anxiety. This isn't just feeling a little worried, it's a pervasive issue that impacts millions. Many U.S. households are simply ill-prepared for financial shocks. In 2018, only 41% of Americans had accumulated savings, while nearly 20% had accumulated debt.
Wow, that's a big gap.
It is. It means a significant portion of the population is living paycheck to paycheck, which is a major ongoing driver of anxiety. The Federal Reserve's 2021 report, for instance, found that 37% of U.S. adults would struggle to cover an unexpected $400 expense.
Just $400.
Yeah, that lack of a buffer is a constant source of worry, keeping our amygdala alarm on a low but persistent hum. And you might be surprised at how demographics play a role in this pervasive financial anxiety. Younger individuals, those aged 21-34, are consistently more likely to feel anxious or stressed. This is largely due to the pressing realities of student loan repayment, accumulating credit card debt, and the immense pressure of trying to establish financial independence in a, well, pretty challenging economic climate. It's not uncommon to hear young people express things like, I have the anxiety of just trying to get out of debt and make a path to financial freedom.
Yeah.
Or lamenting, if I get set back now, then I'm not really putting money aside so that it grows exponentially. It's kind of just going in the reverse way that it should. That feeling of fighting an uphill battle is a significant emotional burden. Gender also plays a significant part. Generally, women are more likely than men to feel financially anxious and stressed. This is often linked to greater caregiving responsibilities, workforce interruptions that impact career progression, and historically lower earning potential, all of which can limit their ability to save for retirement.
That makes sense.
However, it's fascinating to note a nuance. Among Black adults, men actually report slightly higher levels of financial anxiety and stress than women. So it shows the complex interplay of cultural and economic factors. Furthermore, minority groups like Black and Hispanic households disproportionately face lower financial resilience, are less optimistic about handling emergencies, and carry higher debt loads. This is often rooted in systemic economic disparity.
Wait, the historical factors.
Exactly, historical factors that have limited opportunities and created intergenerational financial challenges. Conversely, higher levels of education and income tend to correlate with significantly lower financial anxiety and stress and a greater likelihood of retirement planning, highlighting the protective effect of knowledge and resources. Beyond demographics, everyday drivers of financial stress are quite common. Unexpected expenses like a sudden car repair, a home appliance breakdown, or medical costs can throw a household into turmoil. Debt, particularly high-interest credit card debt and student loans, remains a pervasive source of anxiety across all age groups, not just the young.
Yeah.
And then we have the insidious trap of comparison. Social comparison, especially amplified by the curated, often unrealistic highlight reels on social media, is a major stressor.
Oh, yeah.
When you see friends buying new homes, fancy cars, taking lavish vacations, it's easy to feel behind, even if you don't know the full financial picture behind those posts.
It really is.
This can drive impulsive, unwanted purchases and deepen financial anxiety. I think we've all been there, scrolling through Instagram, and suddenly that voice in your head pipes up, maybe I do need that new gadget. And the long-term consequences are stark. Anxious or stressed households are significantly less likely to plan for retirement, thus reinforcing a cycle of financial vulnerability.
That social comparison trap is so insidious, isn't it? It's a constant battle against the urge to keep up. It also makes me think about how we perceive risk. Do these anxieties skew our view of what's truly risky or safe?
Absolutely. Our perception of risk is heavily influenced by these factors. So, next up, let's consider risk perception and regret aversion. How we perceive risk heavily influences our investment choices. Studies show that a higher risk perception actually positively influences stock investment decisions.
Like positively, that sounds counterintuitive.
Yeah, it does. But the idea is that people who are more aware of risks see stocks, despite their volatility, as a more traditional and potentially rewarding asset class for long-term growth compared to, say, just holding cash. They see the potential upside that justifies the perceived risk. Interestingly, the same positive influence isn't seen for cryptocurrency. Some studies even suggest a negative influence, meaning people might perceive crypto as much riskier due to its volatility and less established nature.
Okay, that makes more sense.
Which makes sense given its relatively short history and wild price swings. Then there's the paradox of regret. Regret theory suggests we make decisions to reduce the likelihood of future regret. In investing, this can lead us to avoid certain decisions not just due to the inherent financial risk, but because of the anticipated emotional pain of a bad outcome.
We've all kicked ourselves later, right?
Exactly. We've all made a financial mistake and thought, ugh, why did I do that? Now, while one study on Norwegian investors unexpectedly found no direct influence of regret aversion on investment decisions, that could be due to Norway's unique context. High standard of living, stable economy, robust social safety nets.
So maybe less fear of the consequences.
Potentially. Those factors might buffer investors against the emotional repercussions of possible financial losses, making them less concerned about regretting a wrong decision. However, other research strongly suggests that fear of future regret, particularly its cognitive, thought-based component, can make us hesitant. Even when our financial knowledge is high, sometimes it leads us to miss valuable opportunities. It's that voice in your head saying, what if I regret this later? That can paralyze action.
So it's not just about what we lose, but the feeling of having made the wrong choice that drives us. That's a powerful motivator. And speaking of feelings, how much do our general moods and emotions play into our investment decisions beyond just fear of regret?
They play an enormous role. Moving on, mood and emotions investing are powerful forces. Our general mood significantly impacts our financial decisions. Positive emotions, maybe after a great day or a recent success, tend to lead to more optimistic evaluations and a higher tolerance for risk. We might feel more confident taking on new investments or riding out market dips.
Feeling good, feeling bold.
Pretty much. Conversely, negative emotions can drive pessimism and risk avoidance, making us pull back or sell impulsively. The classic market emotions, of course, are fear and greed. Fear, as we know, often triggers panic selling during downturns, a classic manifestation of loss aversion. That's the idea where the pain of a loss feels, psychologically, about twice as intense as the pleasure of an equivalent gain.
Right. Losing $100 feels way worse than finding $100 feels good.
Exactly. And it's not just selling, it drives that insidious disposition effect, where investors cling to their losing stocks, hoping for a comeback, while prematurely selling their winners to lock in a small profit. Think of all the money left on the table by selling Apple too early, or the deeper hole dug by holding on to a struggling stock for years just because you couldn't stomach realizing the loss. Conversely, during extended bull markets, greed and overconfidence can take hold. Investors might become overly optimistic, chasing trends, increasing their exposure to high-risk assets.
FOMO, fear of missing out.
Exactly, FOMO takes over, leading them to suffer significant losses when the market inevitably corrects. It's that feeling of, everyone else is getting rich, I need to jump in now. What's fascinating here is also the concept of the fantastic object. This suggests that our unconscious desires and fantastical illusions can sometimes dominate rational analysis when navigating investment uncertainties. Essentially, we project our hopes and fears onto investments, imagining them as magical solutions to our financial woes, or, conversely, as impending doom, overriding clear-headed analysis.
That's a powerful point about how deeply rooted some of these drivers are. It reminds me of those subtle mental shortcuts our brains take all the time, not just in finance, but everywhere. Let's delve into those cognitive biases, the mind's shortcuts. How do these everyday mental habits lead us astray with our money?
Excellent point. These cognitive biases are mental shortcuts our brains take, often to save energy, but they can frequently lead us astray, especially in the nuanced world of finance. One of the most prevalent is the anchoring effect. This is a mind-bending shortcut. Our brains get stuck on the very first number or idea we encounter, even if it's totally arbitrary. Think of that famous study by Dan O'Reilly. People were asked to consider paying the last 2 digits of their social security number for an item and then bid for it.
Using their social security number. That's random.
Completely random. But those with higher SSNs ended up bidding significantly more, up to 120% higher.
No.
Yes. In investing, your first purchase price for a stock can become an unconscious anchor. It might make you hesitant to buy more if the price dips, even if the fundamentals are good, or reluctant to sell if it goes far above your initial anchor. The key insight. Be intensely aware of the first numbers you're exposed to. They might be quietly dictating your decisions. This bias is incredibly difficult to avoid and can be surprisingly durable. Even groups aren't immune. They can be as biased or even more biased than individuals, especially if the first person to speak strongly influences the discussion.
Oh, groupthink combined with anchoring.
Exactly. And mood matters too. Studies suggest sad people are more susceptible to anchoring than happy or neutral individuals. Then we have confirmation bias. This is something most of us are familiar with, that tendency to seek out information that confirms what we already believe and actively dismiss or ignore anything that challenges those beliefs.
We all do it.
We do. But what's truly insidious in finance, especially today, is how it's supercharged by algorithmic feeds on social media and financial news sites. It's not just that we look for affirming news, it's that it's fed to us.
Creating echo chambers.
Precisely. Creating financial echo chambers that can lead to disastrously narrow perspectives. Imagine an investor who is incredibly optimistic about AI stocks. This bias would lead them to only seek out positive news about AI, ignoring any potential downsides like overvaluation or ethical concerns. This, of course, can lead to potentially very bad decisions because they're building their strategy on an incomplete picture. The endowment effect, coined by economist Richard Thaler, shows how our emotional attachment can inflate the perceived worth of something we already own. We tend to value objects we own more than identical objects we don't.
Like my old concert t-shirts.
Yeah.
They're probably worthless, but I wouldn't sell them cheap.
Exactly. That's the endowment effect. It makes us reluctant to sell assets, even at a fair market price, simply because of that emotional connection. Research suggests this involves an interplay of risk aversion and inertia. We're hesitant to change the status quo. Research even suggests physiological responses, like pupil dilation, can predict when we're ready to make a deal, signaling increased mental effort linked to the decision of parting with something we own.
Wow. Our eyes give us away.
Apparently so. Recency bias is another common pitfall. We place more importance on what just happened or what's currently top of mind, giving it disproportionate weight. If all you're reading is negative market news, you might feel an immediate, urgent need to act, even if the long-term facts about the underlying value of your investments tell a completely different story.
It's why people panic sell during a brief downturn, forgetting decades of market growth.
Exactly. They overweight the most recent, scary information. The herd effect is the classic fear of missing out, or simply following the crowd. This can lead to irrational surges in buying during a bull run where everyone piles into the latest hot stock, or panic sell-offs during a downturn, often completely detached from fundamental value.
Keeping up with the Joneses, financially.
Pretty much. It's the powerful urge to be part of the group, even if the group is heading off a cliff. And finally, optimism and overconfidence. While a healthy dose of optimism can be beneficial, excessive optimism and overconfidence can lead to reckless risk-taking, an inability to properly analyze investments, and ultimately significant financial losses. Investors might genuinely believe they can outsmart the market or accurately predict future movements, leading them to ignore crucial risk factors and diversify insufficiently.
That feeling of, I've got this figured out.
Right, I know better than everyone else, which often precedes a significant financial misstep.
Wow, okay. That's a lot to contend with. It really highlights how our brains are incredibly powerful, but clearly have some significant quirks and biases when it comes to money. It makes me wonder, given how deeply ingrained these biases are, like that anchoring effect, which sounds almost impossible to avoid, is it even realistic to try and outsmart our own psychology? Or is it more about learning to work with these tendencies? What can we actually do about it? How can we harness all this understanding to make smarter, more rational financial choices, especially when things get stressful or emotions are running high? Hashtag strategies for navigating emotional risk and making rational choices.
That's the million-dollar question, isn't it? And you've hit on a crucial point. It's less about eradicating emotion entirely that's impossible and, frankly, undesirable, and more about managing its influence and understanding our default settings. So, how do we shift from being reactive to being proactive and disciplined in our financial lives? The good news is there are concrete strategies you can implement. First, let's talk about one, proactive planning and discipline. The most fundamental step is to create a financial plan. Think of this as your personal roadmap, your GPS for financial success. You need to set clear, specific financial goals and timeframes, whether it's saving for a house, retirement, a child education, whatever matters to you.
Got it. Have a destination.
Precisely. A well-defined plan, ideally created during calm times, helps align your decisions with your long-term objectives rather than being swayed by short-term emotions or market noise. It encompasses budgeting, saving, investing. You need to know where you're going to make intentional choices. Without a plan, every financial decision feels like an isolated, emotionally charged event. Equally crucial, and a direct antidote to financial stress, is to build an emergency fund. We're talking 3 to 6 months of living expenses tucked away in an accessible, safe account, not tied up in volatile investments.
The rainy day fund.
Exactly. This fund is your first line of defense, your financial shock absorber. Imagine your car breaking down or an unexpected medical bill landing on your lap. Without this buffer, those shocks immediately trigger that amygdala response we talked about, leading to panic, potentially high-interest debt, or impulsive selling of investments. Having this fund isn't just about financial security, it provides immense psychological relief. A quiet confidence that lets your prefrontal cortex stay in charge even when life throws a curveball. It's literally buying yourself peace of mind. Then, you need to address debt strategically. Prioritize high-interest debts like credit card balances and work to pay them down first. This isn't just about saving money on interest. It can significantly reduce financial stress, free up cash flow, and prevent the snowballing effect of interest that can feel overwhelming.
Getting that weight off your shoulders.
Absolutely. Consider the debt snowball or debt avalanche methods to give you a clear, achievable path. Cultivate a long-term perspective in your investing. This sounds simple, but it's incredibly powerful in combating recency bias and emotional swings. Short-term market fluctuations are notorious for triggering emotional decisions that often harm overall financial well-being.
Stay focused on the horizon.
Right. By focusing on your long-term goals, retirement in 20 or 30 years, for example, you're less likely to panic during dips or get overly exuberant during rallies. The market is a marathon, not a sprint, and your financial plan is your pacing guide. Implement periodic rebalancing of your portfolio. Regularly adjusting your investments back to their target asset allocation helps maintain diversification and prevents emotional drift.
So you don't end up too heavy in one area.
Exactly. This ensures you're not overexposed to any single asset class just because it's been performing well, keeping your portfolio aligned with your original risk tolerance and objectives. It's a systematic way to buy low and sell high without letting emotions drive the bus. And here's a practical, simple trick. Keep a money journal. Consider making a quick 30-second entry whenever you make a meaningful financial decision. Note the date, the context, your emotion at the time. Were you excited, scared, pressured, the decision you made, and why you made it? This consistent habit builds incredible self-awareness about your triggers and patterns over time. You'll start to see your own biases in action, which is the first step to mitigating them.
I love that money journal idea. It's like a financial therapy session you can do every day. It really highlights that self-awareness is key. So once we have that awareness, how do we actively manage those emotions and cognitive tendencies? What about regulating ourselves when those old habits start to kick in?
Exactly. Self-awareness is the bedrock. Second, we focus on two: emotional and cognitive regulation. Cultivate financial mindfulness. This is the practice of being fully present and aware of your financial activities without judgment or overwhelming emotional reactions. It means truly understanding where your money is going, recognizing your spending and saving habits, and making deliberate decisions instead of impulsive ones.
Being present with your money.
Right. At its core, financial mindfulness is about bringing moment-to-moment awareness to financial choices, echoing broader mindfulness techniques. It helps you avoid the ostrich effect, burying your head in the sand about debt, and significantly improves your planning by aligning those small daily choices with your big future goals. It's about being present, not just reactive. To support this, incorporate meditative practices. Techniques like deep breathing exercises or meditation can be incredibly effective in managing the stress associated with financial issues. These practices promote clearer thinking and enhance overall mindfulness, which directly translates to better financial decisions. When your body is calmer, your prefrontal cortex has a better chance of staying in control.
Even just a few minutes a day could help.
Absolutely. Apps like Calm or Headspace can be excellent tools to guide you through this, even for just a few minutes a day. Actively practice emotional self-regulation. When faced with stressful financial stimuli, you can employ techniques like reappraisal. Reinterpreting the situation. For example, this market dip isn't a disaster, it's an opportunity to buy low. Or distraction, shifting your focus to a non-financial task for a short period. Or even suppression, consciously holding back an impulsive emotional response. Your ability to regulate these emotions directly impacts the rationality and effectiveness of your financial decisions. It's like having a mental toolkit for emotional emergencies. Finally, recognize and actively mitigate your cognitive biases. Awareness is always the first step. Regularly reflect on your decision-making process.
Asking yourself the hard questions.
Exactly. Are you relying on reliable data, or are you being unduly influenced by an arbitrary anchor or information that merely confirms what you already believe? Critically assess your judgments. Consider the opposite strategy, where you actively seek out information that might contradict your initial belief, can be a powerful tool to help counter biases, like anchoring and confirmation bias. It's like playing devil's advocate with yourself.
Those are powerful personal strategies.
Mm-hmm.
But often, our financial lives aren't lived in a vacuum. We have partners, advisors, social circles that influence us. So beyond our own internal work, how do we leverage external support and continue to grow our financial intelligence?
That's an excellent point. Our financial ecosystem is complex, and external factors and continuous learning are key for three: external support and continuous learning. One powerful strategy is to consult financial advisors. Professionals can provide objective, unbiased advice, helping you make decisions based on a broader market perspective, free from your personal emotional biases.
An outside perspective.
Exactly. They can also tailor investor education to different risk profiles, guiding you with expertise and a crucial dose of external objectivity when your emotions might be clouding your judgment. It's like having a co-pilot who isn't susceptible to your particular brand of panic or euphoria. If you're managing money with a partner, teamwork in financial partnerships is essential. Avoid fault-finding, which only shuts down problem-solving. Instead of phrases like, "you always overspent," try, "what's our next best step?"
Focus on solutions, not blame.
Precisely. Consider a simple division of labor where one partner handles day-to-day bills and the other monitors savings and investments, playing to each other's strengths. Crucially, schedule regular money dates, maybe monthly, for 30 minutes, phones away, to discuss finances proactively and avoid expensive silences where small issues quietly grow into big ones.
Money dates, I like that.
Yeah. And if a conversation threatens to heat up, use a simple rule: 10 minutes for each person to share their view without interruption, followed by 10 minutes to list options. This fosters alignment and reduces surprises, building a stronger financial unit. Actively avoid social comparison. Social media makes it so easy to feel behind when you see others' seemingly perfect lives and upgraded purchases. Instead, measure your progress against your own baseline. Track your personal savings rate, your debt-to-income ratio, your net worth trend. If these numbers are improving quarter by quarter, you are on the right path, regardless of what anyone else posts online. This shifts your focus inward, away from external, often misleading benchmarks, and helps you appreciate your own journey. Invest in financial education. Continuously learn about managing money, investing, and behavioral finance. Knowledge is a powerful tool for making informed, mindful financial decisions. This includes everything from formal courses to reputable financial blogs and podcasts like this one.
Absolutely.
The more you understand the landscape and your own psychology, the better equipped you are to make choices that serve your long-term goals. And of course, diversify your portfolio. Spreading investments across different asset classes reduces overall risk. This strategy helps prevent emotionally driven decisions that might arise from the poor performance of a single investment, smoothing out the ride and reducing anxiety during market volatility.
The classic, don't put all your eggs in one basket.
It's a classic for a reason. It works.
That's brilliant. Especially the idea of money dates with a partner and focusing on your own progress rather than external comparisons. It's so easy to fall into those traps. But what about when we do make mistakes? We all have financial regrets. How do we move past those? Because they could really weigh you down.
Past regrets. We all have them, myself included. Fourth, let's address 4. Addressing past regrets. It's easy to dwell on financial mistakes, a car you overpaid for, an investment sold too soon, lingering credit card debt. But give yourself grace.
Be kind to your past self.
Exactly. Everyone has money regrets. Carrying them around doesn't help your future choices. In fact, it can paralyze you, reinforcing that negativity bias. Forgive your past self. You made the best decision you could with the information and emotional state you had at the time. Then, commit to a new rule. Translate that regret into positive action by establishing a new financial rule going forward. Maybe it's get 3 quotes before any repair, or sleep on purchase ideas that will exceed $200, or automate retirement contributions on payday.
Make it concrete.
Right. Write your rule on a sticky note and put it where you make decisions. Then, crucially, take immediate action this week to implement that rule. Progress is the most powerful antidote to regret. It allows you to transform a painful memory into a proactive lesson. Finally, let's touch on 5. Consider ethical investing. Beyond purely financial returns, an increasing number of investors are driven by ethical and environmental concerns. Sustainable investing often satisfies moral and psychological demands, providing a genuine warm glow, a satisfying sensation that comes from making a positive impact on society even after adjusting for financial performance.
So it feels good, basically.
It does. A German study, for instance, found significant preferences for sustainable funds, driven by non-financial factors like altruism, environmental concern, and most importantly, emotional fulfillment. This demonstrates the powerful influence of non-financial factors in our financial decisions, showing that wealth management can extend beyond just numbers to align with our deepest values. When your investments align with your values, it can reduce a different kind of anxiety, fostering a sense of purpose and integrity in your financial life.
What an incredible range of insights.
Yeah.
From the very biology of our stress response, how our amygdala can hijack our rational prefrontal cortex, to the subtle cognitive biases like anchoring and the endowment effect that color our judgment, and then to a clear roadmap of actionable strategies. This deep dive truly shows that understanding ourselves is the first, most crucial step to mastering our money. It's about self-awareness and conscious action, recognizing that our emotions aren't a weakness, but a force we can learn to manage.
Absolutely. Think of it this way. Our brains evolved to survive saber-toothed tigers, not stock market volatility.
Right.
So it's no wonder we have these inherent biases. But by understanding them, by building those consistent habits and seeking support, we can essentially update our internal software to thrive in the modern financial jungle. It's an ongoing journey of self-discovery and discipline. #tag outro.
As we wrap up this in-depth exploration into the science of financial decision-making under stress, I really hope you're leaving with a renewed sense of clarity and empowerment. We've seen how our brains, for all their brilliance, can lead us down tricky financial paths when emotions and biases take the wheel. But more importantly, we've discovered powerful strategies, from mindful money management, thoughtful planning, to seeking external support and transforming past regrets into future rules that can help you steer confidently towards your financial goals.
Remember, taking control of your personal finances isn't about being perfectly rational all the time. That's an unrealistic ideal. It's just not how we work. Instead, it's about building awareness of your own psychological tendencies, implementing simple, consistent steps, and having the right tools to overcome those inherent psychological hurdles.
Yeah.
You are absolutely not alone in facing these challenges, and the insights from behavioral finance offer practical and accessible solutions for everyone, regardless of their current financial situation or experience level.
We truly value you joining us for this in-depth exploration. If this deep dive resonated with you, if you had any aha moments, or if it sparked further questions about your own financial psychology, we'd love for you to share your thoughts. Leave a comment, tell a friend, or share this deep dive with anyone who might benefit from understanding the psychology behind their money. Your engagement helps us build a community of financially empowered learners. And for one final thought to mull over as you go about your day, if our emotions and biases are so deeply intertwined with our financial decisions, how might recognizing these patterns not just help us manage our money more effectively, but fundamentally reshape our entire relationship with wealth itself? What kind of wealth would we truly choose to build then, knowing what we know about ourselves? Until next time, keep exploring, keep learning, and keep making those informed, intentional financial choices.